All right. Starting off with the last part, guys, that we have with regards to revenue. We want to do a few sums and get a strong hold of this particular topic here. So through TYUs only, it's the best way to study revenue. We'll just keep doing the TYU and then come back to the topic. So here we'll look into illustration 5 to understand consignment and make sense of it. So practical POV. Okay, so now let's look into this, what's happening here from the consignment perspective. Okay. Starting off with here is how do we understand consignment? Let's look into that. So on 1st January 2003, Ford Motor Co., a car, entered into an agreement to provide Dusty, a car retailer, with cars for resale. So on 1st January, what happened? The Ford Motor Co. is a car manufacturer. They entered into an agreement to provide Dusty, a car retailer, with cars for resale. Okay. On 1st January 2003, what happened? Ford Motor Co. Which company? Ford Motor Co. Okay, what did they do? What did Ford Motor Co. do on 1st January? On 1st January, Ford Motor Co. is a manufacturer. Okay, what is Ford Motor Co? Ford Motor Co is a manufacturer. On 1st Jan 2003, what happened? Ford Motor Co, a car manufacturer, it entered into an agreement to provide Dusty, a car retailer, with cars for resale. Right? It entered into an agreement to provide Dusty, which is a car retailer, with cars for resale. Okay, so on 1st Jan 2003, Ford Motor Co., a car manufacturer, entered into an agreement to provide Dusty, a car retailer, with cars for resale. So Ford Motor Co. is a manufacturer, Dusty is a retailer. Manufacturer will provide cars to Dusty and then Dusty will sell it forward. Okay. The terms of the agreement are as follows. Okay. What are the terms of the agreements are as follows? What are the terms of the agreements? That Dusty must pay the cost of insuring and maintaining. Maintenance and insurance Dusty will pay. Okay. Maintaining and insuring Dusty will pay. Okay. Dusty can display the cars also from the showroom. Okay. Then when a car is sold to the customer, Dusty will pay Ford Motor the factory price prevailing at the time the car was originally delivered. Okay. So basically, I'm keeping my car in Dusty's office. Ford Motor Co is keeping the car in Dusty's office. And if Dusty sells it forward, then he will give the money to Ford Motor Co. And how much money? Will they give the entire money? No, he will give the prevailing factory price at the time the car was originally delivered. That time when he delivered it, that time he does not need to pay. When Ford is delivering to Dusty, that time he didn't pay. When Dusty sold it to someone else, that time Dusty paid the factory price. Up until that time, the goods, even though it was in Dusty's godown, it was still of Ford Motor only. That it was just kept in Dusty's. Okay. All cars remaining unsold for 90 days after their original delivery must be purchased by Dusty at the factory price prevailing at the time of delivery. If anything was unsold for 90 days, okay, it must be purchased by Dusty at the factory price prevailing at the time of delivery. And if within 90 days Dusty can't sold it, then Dusty will have to buy it. Okay, if 90 days Dusty can't sell it, Dusty will have to buy it. So what is the arrangement here? Ford will provide his car to Dusty. That time Dusty will not pay any money. The car will be in Dusty's showroom. Dusty will show that car to all the customers. If Dusty sells that car, then he will give the factory price to the Ford Co. If he is unable to sell it within 90 days, he will himself buy the car from Ford. And same, he will pay the same price when the car was delivered at the factory price when the car was delivered. That is the arrangement. Okay. Now this is from the Dusty's POV. Now let's look into some more topics here. Ford Co can require Dusty to return the time any time within 90 days. Within 90 days, if Ford Co wants, he can ask to please give me the car. If Ford Co wants during that 90 days, anytime he can tell Dusty to return the car. If Ford Co wants, within the 90 days, he can tell Dusty to return the car anytime. Okay, if Ford Co wants, he can require Dusty to return the car anytime. Okay, if Ford Co wants, okay, if Ford Co wants, right, if Ford Co wants, he can tell Dusty to return the car anytime but within that 90-day period. Okay, Dusty can return the unsold cars at any time during the 90-day period. Even if Dusty wants, he can also return the car without penalty. He can return the car within the 90 days. With 90 days, he can keep it in his godown. It sells, it doesn't sell. He can still return it within 90 days. But the moment 90 days is crossed, and if he's not returned it, then he will have to buy it. At 31st December, the agreement is still in force and Dusty holds several cars which were delivered less than 90 days earlier. So for 90 days, he can return the car. It's like a trial period. Within 90 days, he can return it and he can ask for it also. He can return it also. 90 days, it is chill. For 90 days, it is very chill. Okay. For 90 days, it is very chill. But after 90 days, what happens? For 90 days, it is very chill. But for after 90 days, what happens? Okay, 90 days it is very chill, but for after 90 days, then Dusty will have to buy it if he's not returned it. So within 90 days, he has to return it. Okay, so within 90 days, he has to return it. He has to return it within 90 days. Okay, he has to return it within 90 days. Okay, he has to just return it within 90 days. That's it. And if he doesn't, then he'll have to buy it himself. And in 90 days, the car is still of Ford. It's just in the godown of Dusty. Okay, let's look into the arrangement here. Arpita, how have you understood the arrangement? What's happening here?
So it starts with Ford Motors being the car manufacturer, and then there's a contract agreement to sell, not sell, to give the cars to Dusty, which is a car retailer, for the sale. And then up to 90 days, it's like uh, is a period where there is nothing. Example, if Dusty sells off the car, then he will pay back to the Ford Motors at the initial contract pricing. But if Dusty doesn't manage to sell anything up to 90 days, then he has to buy it eventually, buy it off Ford. And within the 90-day period, Ford has the full control. He's just letting the retailer put the car in the meantime. So Ford has the authority to pull back, like take back the cars at any point, and even Dusty can return the cars within the 90 days. It's a flexible period.
Perfect. Okay, that is a clear understanding about everything. That within 90 days, even Dusty can return, even Ford can ask it back. But if it's 89 days, he has not sold it, no problem. 90th day, he can return it with no penalty. So every car he can keep for 89 days and he can just return it if it's not been sold. No problem. But if it's 90 days crossed, then Dusty will have to buy it. But if 90 days have crossed, then Dusty will have to buy it. That is a consignment inventory. That is our consignment inventory. Okay. So now how should it be treated in the financial statement is the question. Okay. The key issue is how it should be treated in the financial statements. Okay. So the key issue is whether Dusty has purchased the cars from Ford or whether they are merely on loan. Okay, in order to decide whether or not Dusty has purchased the car, we need to determine whether control has been passed from Ford to Dusty. In other words, Dusty is receiving the benefits of holding the car and is exposed to the risks inherent in those benefits. So Ford Motor Co can demand the car anytime from Dusty. Okay. Ford Motor Co can demand the return of the cars and Dusty is available to return them without paying a penalty. This suggests that Dusty does not have any right to retain them. Okay, so Dusty incurs the cost of maintenance and which is a cost normally associated with holding inventories. So the purchase price is at the price at the time the cars were first delivered. This suggests that the sale actually take place at the delivery date because it is Dusty that will benefit from any price rise and suffer if the price goes down. So it appears that both the parties experience the risk and benefits. However, although the agreement provides the return of the cars at either party's request, in practice this has never happened. So in concluding it, the cars are assets of Dusty and it should be included in its statement of financial position. Ford will recognize revenue when the cars are dispatched to Dusty. Okay, so what is happening here is that Ford will recognize a revenue the moment the cars are dispatched to Dusty. Now, why are we telling that Dusty is the owner? Right? What about it is telling us that Dusty is the owner? Because see, if the car increases in value, right? If car increases in value or the car decreases in value, any which way, Dusty will have to pay the fixed factory price. Maybe the price has gone down below the factory price also. Still, Dusty will have to pay the factory price only. Right? So Dusty will benefit from the increase in price, but he will also suffer from the price going down. So based on that, we are saying that it's the Dusty who has purchased the car and it's the Dusty who should recognize it in its financial position. Though Ford has the right, they are not denying that also, that Ford also has the right to call it back. Right? Although the agreement provides that either party's request, this has actually never happened. The fact that it has never happened is something that they have highlighted here. It's never happened, this thing, that they've called it back. Okay. And also, maintenance car is also something that you pay when you hold the inventory. You also pay the maintenance. When you hold the inventory, you also pay the maintenance. Okay. Whenever you hold the inventory, also you pay the maintenance. Okay. Whenever you hold the inventory, you still also pay the maintenance that time. Okay. So even when you hold the inventory, you still pay the maintenance. So Dusty incurs the cost of insurance and maintenance. Cost normally associated with holding inventories. Okay. So Ford Co can demand the return of the cars and Dusty is able to return the car without a penalty. This suggests that Dusty does not have the automatic right to retain it or to use them also. Okay. This suggests that Dusty does not have the automatic right to retain or the automatic right to use. Okay. The Ford Co can demand the return of the car and Dusty is able to return them without paying a penalty. Yeah. Dusty is able to return them without paying a penalty. This suggests that Dustico does not have an automatic right to retain or to use them. Okay, so this is a point that is giving a little contrasting POV, but overall, all the points are just saying that since Dusty is always benefiting from the price increase or the losing from the price decrease. So if the price has decreased so much and in the market it is selling below the factory amount, still Dusty will have to pay the factory amount only when buying the car or when paying for the car. So even if it is goes up also, it still has to pay the factory amount. So he's benefiting from the price increase and decrease. And that itself is such a powerful factor that has single-handedly rendered the owner as dusty. The fact that he will benefit from any price increase and suffer if the price goes down. Right. So any increase or decrease in the price, the one who holds the benefit and the loss of the same is has been the reason why Dusty has been given as the owner of the particular car. Okay, and he will recognize it in the balance sheet. Now we'll read the case, no doubt, and read the three lines that are there here. Where one party legally owns the inventory, but other party keeps the inventory. The key issue relates that which party has majority indicators of control. Right? In this case, Dusty has the majority indicators of control and he should include it in its balance sheet. Fraud will recognize the revenue the moment the cards are dispatched to Dusty. Okay, the moment it is dispatched to Dusty, Ford will recognize it as revenue. That is about a consignment. Okay, that is about consignment. And now what we'll do is we'll look into recognizing revenue. Okay. So we'll look into recognized revenue. First, we'll understand all the arrangements that are there. So first is this. Next, we'll look into repurchase agreement. What happens in a repurchase agreement? It's a short one here. So Adgalen sells a maturing inventory with a cost of 1 million to Alba. There are two people, Adgalen and Alba. Adgalen and Alba sells maturing inventory with a cost of 1 million. How much is he selling the inventory? He's selling it at a cost of 1 million. Okay. So Adgalen is selling its maturity and he's selling it to Alba at 1 million. Okay. With the cost is 1 million, he's selling the inventory. Okay. The cost is 1 million, he's selling the inventory to Alba, a bank for its fair value of 1.5 million. Right. For the fair value of 1.5 million, he's selling a car worth cost is 1 million, he's selling it for 1.5. Adgalen has the option to repurchase the inventory for 2.2 million. Right. And he has an option to repurchase it also. Right? He has an option to repurchase. Very important. Okay. He has an option to repurchase. Okay. He has an option to repurchase for 2.2 million. At a greater price, he can repurchase the inventory in the future. So cost is 1, sold it for 1.5, can purchase it back for 2.2. Adgalen has will continue to hold the inventory within its warehouse as normal throughout the period. He will continue to hold the inventory within its warehouse as normal throughout the period. And so is responsible for its maintenance and insurance also. Adgalen is responsible. Who? The initial guy. Right? The guy who initially sold, he's only responsible for maintenance also. And at 31st, the inventory is expected to have a fair value of 4 million. So now see, he can benefit from the fair value or not. Right? Can he increase? He will definitely benefit from 4. If Adlin wants, he can buy it back for 2.2 and sell it immediately in the market at 4. So any increase or decrease, he can benefit from that. Right? He can increase or decrease, he benefits from that. If you see the fair value gain, he still has the right to benefit from the gain of the asset. Right? He still has the benefit. So see, it is expected that the car will be 4 million in the future, the inventory will be 4 million in the future, and he can buy it back for 2.2. Will he not benefit from the upside? He will. And if he can, then he still has the control. right? If the party who can still benefit from the upside has that party has the control. Okay, so if you look here, Adeline has a right to repurchase. The repurchase price is greater than the original selling price for sure, and the contract is therefore treating as a financing arrangement. Okay, Adeline should not derecognize the inventory but continue to recognize it as an asset. So Adeline is never derecognizing the inventory; it's still Adeline's only. This transaction in substance is basically a loan with an effective interest of 0.7. They're saying this is a loan agreement that basically today I'm giving you 1.5, tomorrow you take it back and you give me 2.2. That remaining 0.7 is your interest, right? The sale proceeds of 1.5 should be recognized as a non-current liability as a loan and with an interest charge on the outstanding amount. The effective interest is 5%. Note that any effective rate question would always be provided within any FR exam question. So you will be getting the effective rate, no doubt. Okay, so here what has happened is the control is still with Adeline. How do I know? Because see, he can still benefit from the upside, right? He or she can still benefit from the upside. Okay, they can still benefit from the upside, and the person who can still benefit from the upside is never fully given the control, right? So Adeline still has to have control because they can benefit from the upside of the value. So how do you treat this transaction? That today it is 1.5 million that you're getting. Later you can buy it back for 2.2. So today you are taken a loan of 1.5. Tomorrow you will return 2.2 and you will take the inventory back. So the 0.7 is the interest that you have kept in between that you are paying basically for the loan that you have taken. And because the maintenance and insurance is also with Adeline, upside benefit is also with Adeline. So with everything pointing toward Adeline benefiting, it feels like this is what Adeline should do. Right? That's the benefit for Adeline. That is the benefit for Adeline. And this is what they are doing. That is the benefit. Okay, so today they're taking a loan of 1.5, tomorrow they are returning 2.2 for it, and they are getting their inventory back. Any upside is also going with Adeline, and they are responsible for the maintenance and insurance. They are responsible for the maintenance, they are responsible for the insurance. They are responsible for the maintenance, and they are also responsible for the insurance. Maintenance and insurance, they are responsible. Simple. Yeah, maintenance and insurance, they are responsible for the maintenance also, for the insurance also. For the maintenance also, they are responsible. For the insurance also, they are responsible. Okay, for the maintenance also and for the insurance as well. That and also the fair value is the benefit of Adeline. So, in essence, this transaction is a loan agreement.
Yeah, question on this.
Yeah,
What if the repurchase price, what if the repurchase price is lower than the original price? So, how the dividend low is 1.5 million,
yeah.
2.2 million, we've got back to 1.3.
Hmm.
Market conditions, does it change anything?
No, as long as he has the benefit to upside, he still has the benefit to upside, right? If tomorrow it becomes 7 million, then he can still get the upside. So as long as he has the benefit, sorry, yeah.
Say 1.5, instead of 2.2 becomes 1.3. Will it still be able to loan agreement? Or how would it be classified? It might not be the case, but it sounds clear.
Hmm. Yeah, as long as see how it's working out over here is that if I as we read this we'll just totally answer this. This is because the customer is not able to obtain all the benefits from the aspect despite having the physical possession. As such, the entity accounts for the repurchase contract as either a lease. So if the repurchase price, like you say, is less than the original price,
Yeah.
okay. As a result, the entity accounts for the repurchase contract as either a lease or a financing arrangement if the repurchase price is more than the original price. Right. So in this case, it is a financing arrangement. If it is the other way around, it is still a lease, but this person is still the owner. Okay. So the fact that it's just an arrangement difference, right? As we read this now, we will unfold everything, but it's just an arrangement difference, but nothing really changes with regards to the control over here, right? So this is not regarded as a sale. But either it can be a financing, either it can be a lease. That's the only point of difference over here. That either it will be a lease, either it will be a this, but in either case, it will not be a sale. Okay. So it's just how you record it will change. Just how you record it will
Yeah.
change. But either ways, it will not be a sale from the point of view of the initial person who sold it. right? Even though initially he has sold it, because he has a right to take it back at his own will and benefit from the upside, it's no longer a sale. Now the question is it a lease? Is it a financing? So now, like we saw here, he could purchase it for 2.2, which is at an amount greater. Then it's a financing arrangement. You are paying interest. If you can buy it at a lesser, then that is a lease. But either ways, it is not a sale. Okay, now we'll get into the details here. Now that we've got the case understanding, let's look into the details. Okay, is it clear, Karan?
Yes, thank you.
Yeah.
Yeah.
Okay. So now let's look into the details here. This is the better way of list understanding is do through a practical sum, and now let's read the theory. It just makes more logical sense. You can relate it to the example. The repurchase agreement is where an entity sells an asset and promises to repurchase the asset. We have just seen it. This is not recognized as a sale. Perfect. But either it can be a lease, either it can be a loan against the asset. So if your repurchase price is higher than your original price, it's the interest. So it is a financing arrangement. And if your repurchase price is less than the original amount that you got, then it will be a for these arrangement. There are generally three forms of repurchase. One, there's an obligation to repurchase. Second, there is a right to repurchase. And third, that the obligation to repurchase at the customer's request. So there are three situations. We'll look into all the three situations. First, if there is an obligation to repurchase. Okay, if the entity has an obligation or a right. So these are the first two cases to repurchase. Has an obligation or right to purchase. Second, at the customer's request, right? First and two are on the top. This is the third one here. Okay. If an entity has an obligation or a right to repurchase the asset, the customer does not obtain the control of the asset. Like we saw, there was no, he could repurchase, so you cannot get the control of the asset. This is because the customer is not able to obtain all the benefit from the asset, despite having the physical possession. As a result, the entity accounts for the repurchase contract as either a lease or a financing arrangement, right? Either it's a lease or a financing arrangement, but it cannot be considered as a sale because some part of the benefit is still with the some part of the benefit is still some part of the benefit. Okay, some part of the benefit is still with the original buyer. Moving on. If an entity has an obligation to repurchase at the customer's request at a price that is lower than the original selling price, then the customer is likely to access the right. The customer is effectively paying the entity to use a specified asset for a specific period of time. So it would be a lease in accordance with IFRS 16. In this case also, it's a lease in accordance with IFRS 16. If the repurchase price of the asset is equal or greater, if the price is lower, okay, here it comes down to being lower or greater. And if it is lower than the selling price, first case, second, it is greater than the original selling price. If the repurchase price of the asset is equal or greater than the original selling price, and it is more than the expected value of the asset, then the contract is in effect a financing arrangement. And if it is at a higher value, then it is a financing arrangement. Okay, if the customer is not likely to exercise the right, the entity accounts for the contract as if it were the sale of a product with a right to return. Right? So in this case, what has happened is, what is the case here? That the entity has an obligation to repurchase at the customer's request. If customer tells you that I want to sell it, you have to purchase it. If the customer tells that I want to sell it back, then you have to purchase it. Okay, you have to purchase at the customer's request. In the first case, it was at their own, they had an obligation, so they have to do it. And here they have a right to repurchase. They want, they can do it. They don't want, they cannot do it. But here, obligation at the customer's request. Now, if the customer says, then only they have to buy it. Then there's no choice. So now you have to look into at what amount is the customer telling you to sell it back to you, right? So do you have to pay more than what you initially paid, or do you have to pay less than what you initially paid? So if you have to pay less than what you initially paid, then what is happening, basically you treat it as a lease. But if you have to pay more than what you had initially given, then it is a financing arrangement, because you're basically paying interest also, right? It's a financing. See, whenever you're paying more, that means some part is interest. It's a financing arrangement. And if the customer is not going to exercise the right, and it's given in the question specifically that the customer is not going to exercise the right, then what happens is you just record it as a sale of a product with a right to return. Okay, you just record it as a sale of a product with a right to return. If it's given in the question that the customer will not, it's given in the question that the customer will not exercise it. If it is given in the question that the customer will not exercise it, okay, if that is clearly given in the question that the customer will not exercise it, then what? Okay, okay, if it's clearly given in the question, okay, if the customer has given in the question that they will not recognize it, right? Clearly they have given that they will not recognize it. Okay. They will not exercise the right. The customer has told that I will not recognize the right. Okay. If the customer has told that I'm not going to recognize the right, if that has happened, okay, if that has happened, if the customer told you will not recognize the right, and if that has happened, okay, then in that case, then you just recognize it as a sale with a right to return. You just recognize it as a sale with a right to return. Just recognize it as a sale with a right to return. That's all. Okay, that is a repurchase agreement with all the theory around it. Okay, it just comes down to whether when you're repurchasing at what price, higher or lower, and before that on whose terms. Are you doing it on your own terms? You're deciding to buy it. If there's an obligation that it has to happen, you have a right to it. Then in that case, again, if it's more, it's always a financing. It's less than it's a lease. Even in the other case, if it's more, it's a financing, and less, it's a lease. But if the customer is not gonna exercise the right, then you can just record it as a sale with a right to return. That's it. Okay, that is your repurchase agreements. Okay, let's make sense of this here, Indrani. What is happening here? दोनों केस में repurchase में what are the three cases? तीनों केस में कैसे हो रहा है इधर?
Obligation, the three cases are obligation to repurchase, right to repurchase, and obligation to repurchase at the customer's request.
Okay.
That kind of miss.
ओके, तो अगर मान लो, ओके, रीड द फर्स्ट पार्ट हियर, अगर आप देखो, जस्ट फॉलो विथ मी, दैट अगर ऑब्लिगेशन और राइट है, ऑब्लिगेशन का क्या मतलब है, आपको करना ही है, और राइट का मतलब आप अपनी मर्जी पे कर सकते हो, ठीक है? ऑब्लिगेशन मतलब आपको करना ही पड़ेगा, और दूसरा है कि आपकी मर्जी, करना है तो करो, नहीं करना है मत करो। इन दोनों केसेस में अगर आप रीपर्चेस करते हो इनिशियल दाम से ज्यादा दाम में, तो आपको उसको, उस पूरे ट्रांजैक्शन को एज अ फाइनेंसिंग अरेंजमेंट लिखना है। और अगर आप रीपर्चेस करते हो एट अ लेसर प्राइस देन यू इनिशियली हैड सोल्ड इट फॉर, देन दैट्स अ लीज अग्रीमेंट। जब आप रीपर्चेस कर रहे हो तो पैसे तो देने पड़ेंगे आपको, अब आप कितने दे रहे हो पे पूरा क्वेश्चन है ना? बात पैसे की है ना? बात सिर्फ पैसे की है एट द एंड ऑफ द डे, है ना? बात पैसे की है। ज्यादा पे कर रहे हो तो वो फाइनेंसिंग अरेंजमेंट रिकॉर्ड करोगे, आप कम पे कर रहे हो तो आप लीज रिकॉर्ड करोगे, बस। और जो नेक्स्ट केस है उसमें क्या है, ऑब्लिगेशन एट द कस्टमर रिक्वेस्ट। अब कस्टमर बोलेगा तो आपको परचेज करना ही पड़ेगा। मान लो वो बोलेगा ही नहीं और दिया हुआ क्वेश्चन में कि उसको बेचने का कोई इरादा नहीं है, तो आपको एज अ सेल रिकॉर्ड कर सकते हो, कोई दिक्कत की बात नहीं है, विद राइट टू रिटर्न। पर अगर वो बेच देगा आपको, अब फिर वापस पैसे पे आ जाता है, कितने प्राइस पे आपको खरीदना पड़ेगा वापस। ज्यादा प्राइस पे खरीदना पड़ेगा तो वो एक फाइनेंसिंग अरेंजमेंट है, और कम प्राइस पे खरीदना पड़ेगा तो एक लीज अरेंजमेंट है। ठीक है, तो आपको बस देखना है कि जब आप रीपर्चेज कर रहे हो कि उसकी प्राइस क्या है। If the repurchase price is equal or greater than the original selling price and is more than the expected market value of the asset, the contract is in effect a financing arrangement. And if it's not the case, then it is a lease. Okay, if the obligation price is at a lower than the original selling price and the customer is likely to exercise the right, then you record it as a lease. तो बस देखना है कि कितने पे आप खरीद रहे हो वापस, बस पूरा केस उसी पे है कि आप कितने पे खरीद रहे हो। ज्यादा पे खरीद रहे हो तो हमेशा ज्यादा पे है तो फाइनेंसिंग अरेंजमेंट है, कम पे है तो लीज है। दैट्स इट। मतलब मर्जी किसकी, आप अपनी मर्जी से। इसका जर्नल एंट्रीज कैसे होगा अभी? मान लो आप इनिशियली आपने सेल कर दिया, जब आपने सेल किया तो आप लिखोगे, इफ इट इज अ सेल, इनिशियली अगर आप सेल कर रहे हो तो आप पूरा पहले अरेंजमेंट देख लो कि अरेंजमेंट में क्या है। अगर वो पहले स्पेसिफाई कर दिया है कि आपको खरीदना पड़ेगा और ये उनकी मर्जी पे आपको खरीदना पड़ेगा, सेल एक ही केस में हो सकता है, ठीक है? वैसे पहले मैं सेल के पॉइंट ऑफ व्यू से बोल देता हूँ, क्योंकि ये एक ही केस में सेल हो सकता है। किस केस में सेल होगा? इफ द कस्टमर इज नॉट likely to exercise the right, the entity will account the contract as it were a sale। तो एक ही केस में सेल होगा ये, कि अगर कस्टमर की मर्जी पे था और कस्टमर बोल रहा है मैं नहीं करूंगा, तो ही ये सेल हो सकता है। तो आप सेल जैसे रिकॉर्ड कर लोगे इसको, क्योंकि अगर ये सारी कंडीशंस थी और ये क्लैरिटी मिल चुकी है और क्वेश्चन में बता दिया गया आपको कि कस्टमर की मर्जी पे था रीपर्चेस एंड ही इज नॉट लाइकली टू रीपर्चेज इट, तो उस केस में आप इसको सेल रिकॉर्ड कर सकते हो। फर्स्ट ऑफ ऑल, इज दिस क्लियर कि एक ही केस में सेल होता है? Are you unclear with the sale case here, इंद्रानी? ठीक है, तो ये एक ही केस में सेल हो रिकॉर्ड करोगे जब कस्टमर की मर्जी पे था और क्वेश्चन में दिया हुआ है कि कस्टमर कह रहा है कि वो नहीं रिकॉर्ड करेगा। ठीक है, तो ये हो गया। केस में। सेकंड में आते हैं अब, बाकी कोई भी केस में आप सेल रिकॉर्ड ही नहीं कर सकते हो। या तो आप लीज जैसे ट्रीट करोगे, अब लीज का अलग एंट्री होता है जो अपन लीज के चैप्टर में एफआर में अभी देखेंगे, आने वाला है। और फाइनेंसिंग अरेंजमेंट में आप लोन रिकॉर्ड करोगे, एक फाइनेंशियल लायबिलिटी रिकॉर्ड कर लोगे। जो भी आएगा एक क्रेडिट एंट्री हो जाएगा, फाइनेंशियल लायबिलिटी का आप रिकॉर्ड कर लोगे। आप क्या रिकॉर्ड करोगे? फाइनेंशियल लायबिलिटी रिकॉर्ड कर लोगे। ठीक है, तो ये आपकी जर्नल एंट्री रहेगी कि जैसे पैसे अंदर आए तो आप उसको एज अ फाइनेंशियल लायबिलिटी का दर्जा दोगे। तो एक लोन रिकॉर्ड कर लोगे, आप उस अपने बैलेंस शीट में एक लोन लिख दोगे। क्या एक ये आया, पैसा आया बट ये एक लोन की तरह से आया, तो फाइनेंशियल लायबिलिटी रहेगा आपका। और एक पेएबल रहेगा कि अब आपने पैसे अंदर आए और आपने वो अब पे भी करने, इट्स अ पेएबल, कि आपको वो पैसे पे करने पड़ेंगे। तो आपका जर्नल एंट्री रहेगा लोन टू पेएबल, क्योंकि लोन भी अंदर आया और आपका एक पेएबल भी बन गया अभी, क्योंकि आपको ये पे भी करना पड़ेगा। तो इनिशियल जर्नल एंट्री वैसे लिख सकते हो, पेएबल है that you'll have to pay it, या बैंक लोन itself is stands for something that you'll have to pay। तो आप कैश टू बैंक लोन कर सकते हो, क्योंकि आप एक लायबिलिटी क्रिएट कर रहे हो। पैसे अंदर आए बट वो बैंक लोन रहेंगे आपके। कस्टमर का नाम लिख दिया, अगर कस्टमर की बात है तो यू विल राइट इट एज अ फाइनेंशियल लायबिलिटी फ्रॉम एक्स, फाइनेंशियल लायबिलिटी फ्रॉम वाई। ठीक है, तो वो जर्नल एंट्री रहेगी लोन की। तो लोन की जर्नल एंट्री करेंगे। और लीज का कैसे करेंगे, वो अभी जैसे लीज का चैप्टर आएगा तब मैं आपको लीज का पूरा अरेंजमेंट बता दूंगा। लीज में एक असेट और लायबिलिटी दोनों रिकॉर्ड करना पड़ता है, तो वो लीज के चैप्टर में उस डेप्थ को अपन टच अप ऑन कर लेंगे। तो राइट नाउ जस्ट से क्या, और लायबिलिटी का अपन फाइनेंशियल इंस्ट्रूमेंट्स का चैप्टर आ रहा है अभी, उसमें देखेंगे। बट एट दिस पॉइंट आई वुड जस्ट से कि आप एक फाइनेंशियल लायबिलिटी, एक लोन रिकॉर्ड कर लोगे आप खाली। ठीक है, और लोन का जो जर्नल एंट्री रहेगा वो आप कर दोगे कि आपको, आपने लोन लिया और वो आपको पे बैक करना है बस। और जो लीज का है उसमें आप एक राइट ऑफ यूज एसेट और एक लीज लायबिलिटी, दो चीज आती है, वो रिकॉर्ड करोगे लीज में। ठीक है, सो दैट इज ना हाई लेवल। अभी मैं लीज के डेप्थ में नहीं जाता हूँ। एक आरओयू और एक एलएल लीज लायबिलिटी आता है। तो राइट ऑफ यूज एसेट और लीज लायबिलिटी, लीज लायबिलिटी प्रेजेंट वैल्यू पे होता है, राइट ऑफ यूज एसेट आपका फेयर वैल्यू पे होता है। दो चीजें आप रिकॉर्ड करते हो लीज के अंडर। अगर ये फाइन ऑपरेटिंग, ये अगर लीज अग्रीमेंट है तो आप राइट ऑफ यूज एसेट और लीज लायबिलिटी, टू थिंग्स यू विल रिकॉग्नाइज एज अ लेसी। ओके, एंड एज अ लेसोर आपको देखना पड़ेगा कि अगर इज इट एन ऑपरेटिंग लीज और अ फाइनेंस लीज। तो अगेन इट गेट्स इनटू दैट। और तो ऑपरेटिंग लीज और फाइनेंस लीज लेसोर के में आता है, और लेसोर आउट ऑफ सिलेबस है। तो ये वाला एज अ लीज के जर्नल एंट्री में नहीं आ पाएगा, क्योंकि लेसोर अकाउंटिंग इज आउट ऑफ स्कोप फॉर एफआर। पर एसबीआर में हम लोग पढ़ते ही हैं, तो इसलिए मेरे को बस पता है कि लेसोर अकाउंटिंग, और लेसोर अकाउंटिंग में या तो फाइनेंस लीज रिकॉर्ड करोगे या तो आप ऑपरेटिंग लीज रिकॉर्ड करोगे। तो वो अब डिपेंड्स अपॉन द सिचुएशन। अगर 12 महीने के अंदर की लीज है तो आप ऑपरेटिंग लीज रिकॉर्ड करोगे, और 12 महीने से ज्यादा है और चार कंडीशन मीट होती है तो आप फाइनेंस लीज रिकॉर्ड कर लोगे इसको। तो वो लीज के अरेंजमेंट में जाएगा एज अ लेसोर, क्योंकि यहाँ पे आप देने वाले बनोगे। आप यू विल बी अ लेसोर जिसने अपना असेट दिया है। तो आप यहाँ पे लेसोर अकाउंटिंग करोगे, लेसी अकाउंटिंग नहीं करोगे, पहली चीज। और लेसोर अकाउंटिंग आता नहीं है एफआर में, वो एसबीआर का पार्ट है, तो इसका जर्नल एंट्री वैसे नहीं आएगा। बट फॉर योर क्लैरिटी आई एम जस्ट टेलिंग यू कि आप एक लेसोर अकाउंटिंग करोगे, और अब देखोगे कि ऑपरेटिंग लीज है या फाइनेंस लीज है। फाइनेंस लीज का अपना जर्नल एंट्री होता है, आप एज अ रिसीवेबल रिकॉर्ड करते हो, और ऑपरेटिंग लीज में अगर आप बस एक पीएनएल में इनकम रिकॉर्ड कर दोगे, दैट्स इट। सो दैट विल बी द एक्सटेंट ऑफ द जर्नल एंट्री जो आप करोगे एज अ लेसोर। पर अगर आप जैसे लीज के चैप्टर में अभी आप आओगे, एक आध चैप्टर बाद आप देखोगे लीज में सिर्फ लेसी अकाउंटिंग ही हमारे सिलेबस में आता है। तो हम लोग को इसलिए ये जर्नल एंट्री एग्जाम में नहीं करना पड़ेगा। बट अदरवाइज आई होप यू गॉट अ क्लैरिटी कि आपको बस बाइफरकेट करना है कि ऑपरेटिंग लीज है या फाइनेंस लीज है, दैट्स इट। ठीक है, इज इट क्लियर हियर इंद्रानी? आई होप आई हैव नॉट कंफ्यूज्ड यू।
Yes, sir.
ठीक है, या मूविंग ऑन नाउ, बिल एंड होल्ड अरेंजमेंट्स, लेट्स लुक इनटू दिस। क्या आ रहा है बिल एंड होल्ड अरेंजमेंट में? इसमें अपने पास कोई सम नहीं है देखने के लिए, तो ये बस एक थियोरी दिख रही है मेरे को बिल एंड होल्ड अरेंजमेंट की। तो देख लेते हैं हाउ डज दिस वर्क। क्या है क्वेश्चन इसके बाद? टी वाई यू 3 है, टी वाई यू 3 में अपन देख लेते हैं ना। तो एक बार थोड़ी सी थियोरी बता देता हूँ ताकि सम भी आपको मजा आए करने में। तो बिल एंड होल्ड अरेंजमेंट क्या होता है कि यू बिल द कस्टमर नाउ बट यू कीप द गुड्स इन योर वेयर हाउस एंड यू डिलीवर इट लेटर, बस। ये बिल आपने आज ही बना दिया, यू बिल द कस्टमर फॉर अ प्रोडक्ट बट द फिजिकल पोजीशन इज ट्रांसफर्ड एट अ पॉइंट इन द फ्यूचर, दैट्स इट। बिल आज बना दिया, बिल आपने आज ही बना दिया, राइट। यू बिल अ कस्टमर फॉर अ प्रोडक्ट टुडे ओनली, आज ही आपने बिल बना दिया। ओके, बिल आपने आज ही बना दिया। ओके, बिल आपने आज ही बना दिया बट फ्यूचर में, बिल आपने आज ही बना दिया बट फ्यूचर में आप उसकी डिलीवरी करोगे। बिल आपने आज ही बना दिया बट उसकी डिलीवरी आप फ्यूचर में करोगे। ओके, you'll bill the customer now, but you keep the goods in the warehouse and you deliver it later. But you bill the customer now. Okay, you bill the customer now, you keep the goods in your warehouse and you deliver it later, but you bill them now. ये होता है bill and hold arrangement. So revenue only, but you recognize revenue only when goods are delivered and when control list passes. Normal rule ये होता है। ये normal rule क्या बोलता है? Revenue recognized, for this to be recognized as revenue, the customer must have obtained the control of the product despite it physically remaining with the entity. अगर customer को, if the customer has got the control, if the customer has obtained the control, then it's given in the question that he has got the control, then you can still recognize it as revenue even though you've not delivered it. Okay, even though you've not delivered it, if the customer has got the control, you can recognize it as revenue. Right? In accrual methods, even if the customer has not received the goods, possession is still with you, but he has got the control. His control is his. Even though it's in your, but control is his, you can recognize the revenue. Okay. And there may be a custodial fee. So if you're keeping it, you can charge him a fee. Right? You're using up the storage space. He's using your storage space. So you can charge a fee. Where the entity recognizes a fee for holding the goods on behalf of the customer. This performance obligation would be satisfied over time. So any revenue recognized, so any revenue recognized on this basis, performance obligation would be satisfied over time. Over time or at a point in time, I'll tell you what it means. Like whenever you buy a car versus you buy and you buy a service, car is at a point in time immediately. The service is over a period of time. Car is at a point in time. Service is over a period of time. Okay. So whenever you buy a car, the car is at a point in time, but the service you get with it, that is over a period of time. So car is at a point in time, service is over a period of time. Okay. The car is at a point in time, the service is over a period of time. Okay. So what you do is there is a car and then there is a service. The car is at a point in time, the service is over a period of time. Okay. The performance obligation would be satisfied over time. So any revenue would be recognized on this basis. Okay. Car is when you get a car and you get a servicing of the car both together. Car and the servicing both. The car is at a point in time. Immediately the car is delivered. Okay. The car is delivered immediately. It's at a point in time. But the service is over time. Okay. That is the meaning of at a point in time and over time. At a point in time means immediately. Over time means over a period of time. So sometimes you can recognize revenue at a point in time. So yesterday we did a sum of 3 lakhs service. A car was 3 lakhs and 1,20,000 was the service. But we would recognize only 3,10,000. 3 lakhs for the car, 10,000 for the service. Right? So here also they are telling that the performance obligation here should be over time. So you cannot recognize the full amount immediately. So any revenue would be recognized on this basis. So we'll do a sum, we'll get it, but I'm just trying to get the gist of it through you. So for a bill and hold arrangement to exist, customer must have requested the arrangement. Customer should request the arrangement. Product must be identified, clearly identified as belonging to the customer, that this particular cartoons belong to this customer or this particular boxes belongs to this customer. The product must be readily available for physical transfer to the customer. It's readily available for physical transfer to the customer. You can readily transfer it to the customer. An entity cannot have the ability to use the product or sell it to someone else. The entity cannot use it, they cannot sell it. They cannot use it, nor they can sell it to anyone. The entity cannot even use it, they can't even sell it. Right? Because it belongs to someone else. If someone else parks their scooter in your parking, you can't sell that scooter off. And you should not even use that scooter. Right? Someone has just parked it in your parking after asking you. That doesn't mean you use it, doesn't mean you can sell off the scooter. It's parked in your parking, it still belongs to them. Right? A scooter is parked in your parking, but it still belongs to them. Okay, now let's look into a question here. And let's see if we can just break it down. Before we go into the next part of the chapter, this contract costing and everything, let's finish this today. The first one, if you see here, John entered into the following transactions during the year. On 1st April, John sold off his factory to Cruffy. He sold it off. A finance company for 800,000. He sold it. John continued to use the factory and was responsible for the insurance and maintenance of it also, even after selling it. John has the right to repurchase the factory for 980,000, representing a 7% growth in the value each year. At 1st April, John had the factory had a fair value of 1.5. So first of all, see, the initial cost, he sold it first for 800,000, but he can buy it for 980. So he's selling at a price greater, right? The repurchase price is greater than the selling price. So treat it as a financing arrangement. Right off the bat, first this should appeal to you. Right off the bat, this should appeal to you first. Okay, right off the bat, this should appeal to you first. Since the repurchase is greater than the original, this should be a financing arrangement. You should not remove the factory, but you should treat that 800 as a loan, and you should record 7% interest every year on that as a finance cost. That's it. That's the first one. Okay, that is the first one here. Repurchase is greater. And if it was lesser, you treat it as a lease. Next, coming to bill and hold. John sells an oven plus spare parts to Marco for 220. Okay, he sold it for 220. The price was split between 200,000 for the oven, 20,000 for the spare parts. Okay. John delivered the machine on 31st March 2007. Okay. But was asked to hold the spare parts by Marco. Machine was delivered, Marco still hold the spare parts. Because Marco factory was very close to John's warehouse, John expects to hold the spare parts for 2 to 4 years. Okay. The parts were kept separately in the warehouse, correct? It can clearly be identified, cannot be used or sold by John, that is also established, and are ready to deliver, that is also there. So John agreed the transaction as it and decided that the holding cost would be insignificant. He would take some holding cost also. So even though John retains the physical possession of the parts, Marco retains the control. This can be in the fact that John cannot even use it and he has to send it at the request. In this arrangement, there are potentially three performance obligations. These will be the provisions of the oven and the spare parts and the storage of the spare parts. However, the storage of the parts is deemed insignificant. Okay, the storage of the parts is deemed insignificant. The performance obligation to provide the machine and the spare parts appear to be met on 31st March 2007. So the full 220,000 revenue can be recognized on this date. How much will be the revenue? 220,000 revenue can be recognized on this date. How much revenue can be recognized? 220,000 revenue can be recognized on this date. Okay. So first of all, he had sells it at oven plus the spare parts to Marco for 220. He sold it at 220. So the full 220 can be recognized immediately. On that day only full 220 is revenue. First of all, let's establish that. 220 is full revenue. That is the crux. Everything else is extra. The main sentence is this. Full 20 is revenue immediately. Full 220 is revenue immediately. If the cost to store the parts has been deemed to be significant and therefore part of the transaction price, the price related to this performance obligation would be separately recognized over the expected period of the holding parts. If the holding cost was a significant part, then you would recognize it over 3-4 years. Right? If it was significant. But they're saying it's insignificant. So they can recognize 220 revenue immediately. Even though the delivery has not happened, they can recognize that revenue. Because the control is transferred. And how is control transferred? Various examples they have given. Okay. How is control transferred? They've given the various examples. Okay. How is the control transferred? They've given the various examples. Okay. That is about this. Okay. So these things, guys, we have to practice once. Yeah. Before I go into the next part, I'm going to create some sums and give it to you. Okay. So try to solve some sums on this because unless you do, these topics will not be very clear. No, because we've got the gist, but there's still more to get clarity on. Okay, consignment.